Recent economic uncertainty, geopolitical tensions, the recent sell-off have some investors considering increasing their allocation to bonds. And with the Treasury Department's upcoming plans for the next quarter's bond issuance, there's a lot to keep in mind for your portfolio. For more on this, we turn to John Buckingham, Kovitz Principal and Portfolio Manager. John, thanks so much for being here. We were just talking about all of this issuance we were seeing in the bond market and the pressure that's been putting on prices. How are you thinking about allocation and or the impact on stocks from these higher bond yields?
Right. Well, I am an equity guy, so naturally I'm going to still be very optimistic about the prospects for stocks. We have to keep in mind that while interest rates have risen dramatically, believe it or not, they're still relatively low versus where they have been long term. Our investment newsletter, The Prudent Speculator, started in 1977. The average yield for the 10-year Treasury has been about 5.84% during that time. So I get that yields are much higher and we got to get used to that. But valuations on stocks, especially the average stock, we have to keep in mind that the overall market has not done well. In fact, is down significantly this year, the average stock, whereas, say, the S&P 500, the Magnificent Seven, if you want to call them that, the S&P 500, of course, is still higher. So there's lots of opportunities for longer-term oriented investors to take advantage of some of the big sell-offs we've seen here in reaction to earnings, especially the Q3 results that, generally speaking, have been very good. But, of course, guidance is always the key, and many companies have not been as upbeat as they might have been in the past.
And John, another, of course, big data point for investors this week will be that Fed policy meeting on Wednesday. I was just talking to Julie about that. The economists, the strategists, the investors we have on, John, they expect the Fed to stay on hold here, to pause. Is that your expectation, John? And just as importantly, when do you think you would expect them to start cutting?
Right. Well, I'm not an economist and I don't play one on TV, but I will say that the consensus is that the Fed is done. And that there will likely be rate cuts starting in 2024. The problem, if you will, for the Fed is that the economy has been so gosh darn strong, with that GDP print last week. So the economy has held up far better than the Fed might have envisioned. But of course, Fed, the rate hikes we've seen, that works with a lag. So ultimately, we do think there will be, a hit to the economy. We don't think that we will have a severe recession. We'd be in the camp that if there is a recession, it'd be relatively mild. But personally, my view is that many stocks have already discounted a severe recession. So if we do get a modest economic slowdown, I think that equities can make some headway as we head into the new year. And the other point I'll make is that, historically speaking anyway, stocks have done well in higher interest rate environments. Stocks have done well in inflationary environments. Well, heck, stocks have done well no matter what the backdrop is. Unfortunately, in the near term, obviously, there can be some volatility, as we've certainly seen here of late.
We have indeed. And yes, stocks over the long term, of course, they do indeed go up. I'm looking, though, at some of the stocks that you like right now. And as a value guy, some of these names, I got to be honest, surprise me, right? If I'm looking at some of the big cap tech names that are on your list, Alphabet, Microsoft, Meta, some of those kinds of names, because those are indeed the ones that you would allude to when you're talking about recent volatility based on the back of higher rates. Are these guys value stocks right now?
Well, we still think they are. Of course, we bought them many, many moons ago at much lower PE ratios than where they're trading today. But again, as a value investor, we're trying to look at where companies we think where they should trade in the fullness of time versus where they are trading today. And keep in mind that names like Microsoft, Meta, Alphabet, Apple, all of these companies have fantastic balance sheets loaded with cash. So higher interest rates from a business perspective, generally speaking, are a positive, not a negative for their overall financial structure. Obviously, higher rates can impact consumers, and that could impact the business and profitability ultimately. But we still think there is value in those names. Now, again, we're selective. Do I think there's value in Tesla? No, I don't think there's value in Tesla. In other names like an Amazon, which I see you have up on your screen, we don't own Amazon. We think it's still a little too expensive, but the Metas, the Apples, the Microsofts, and the Alphabets are names that we do own. But again, when we look at our portfolios, our forward PE ratio in our newsletter portfolio is below 12. And we think that's very attractive. And again, we are a value shop, and our metrics on our stocks are actually cheaper than the value indexes, and our dividend yields overall are higher than the value indexes.
And John, I want to switch gears here to talk about geopolitical risk a bit, specifically the Israel-Hamas war. John, I was just two questions for you. One, are you surprised at how relatively calm the oil market has been in response to this conflict? And two, John, how do you think investors should think about this risk, both short-term and long-term?
Well, it certainly does throw additional uncertainty onto the heap. We already have a lot of uncertainty, and this isn't the only conflict going on. We can't forget that Russia-Ukraine is still dragging on as well. So this is a very strategic part of the world. The concern, of course, is that it escalates more than it already has. And you are right. The price of oil, one might think, would be a little higher if people thought that we were going to see a severe escalation in that. So from my perspective as an investor, as you're looking to put money to work today, I think energy stocks are a good place to be. Again, I know they're getting whacked today, as you have the graphic there. The price of oil has come down considerably. But names like EOG Resources, Exxon, a company called Total Energy out of France. There's lots of opportunity, I think, in energy, and investors should be going in that direction. Now, conversely, we see today and here recently, companies that are in the EV space. I mentioned Tesla. We're not fans of Tesla, but we do like a lithium producer called Albemarle. Now, it's been extraordinarily volatile, and we've taken money off the table when the stock was above 200 and bought it when it was in the double digits, but it's approaching double digits today. So if you like the EV space, there are ways to play that with inexpensively priced stocks like an Albemarle, ticker symbol's ALB there.
John Buckingham, thank you so much for joining us today, John, and for those stock picks.
Thank you.